The market is in the middle of a correction phase, and it's going to come down to Wednesday, January 15th, to determine whether the market can rebound or dip further into negative territory. In last week's analysis, we covered why the market is so weak and the technical indicators to track a rebound. Fast forward to this week, interest rates continue to rise and market breadth continues to weaken. And like we talked about, this is the recipe for a 10% correction that is likely determined on January 15th.
The 10-year could very easily break well above 5%.
Although inflation has been trending lower, over the past couple months, the trend has started to inflect higher. And as inflation has been trending higher, interest rates have begun to rise, putting pressure on markets.
Small stocks are hurt because if the Fed doesn't cut, their interest costs remain high. The tech stocks don't borrow at those interest rates, but they have to worry about discounting. And since they're, such high PE ratios, a small change in discounting send them lower. So both those have, for different reasons, been depressed by the strong economic growth.
As a result, the number of stocks rising above the 200 daily moving average has pretty much collapsed. The dollar is rising, signaling a flight to safety, and oil is starting to break out, lifting the future expectations of inflation.
And how do you explain why the Fed cuts rates in the long end has gone up so strongly as it has?
If growth is going to be higher than what people thought, the speed at which the Fed is going to be reducing down to neutral is slower than what they thought it's going to be. If you think the growth rate is going to be higher, I think that could be contributing to it as well.
The Federal Reserve might be cutting the level of rates, but their expectations have actually tightened as they aim to cut less in 2025, and some believe they might not cut at all.
Are you thinking that the Fed might not cut anymore? I know you said the market might be thinking that. Does that match with your own view? And do you really think that the 10-year could get substantially over 5%?
I think it could. Really, the market is saying maybe no rate cuts. A cut has really been wiped out. And looking at history, I was saying that is actually a formula for higher long-term rates.
Markets like loose, easy conditions, and this is a full-on tightening of financial conditions. At a time when valuations are stretched, the rally is narrow, and a lot of stocks are just straight up overbought.
I don't think we're going to see another 20% year. We've had two really big years of gains. And when you look historically, when a bull market reaches its second year, historically they last about 5 years, but that third year tends to be weaker than average. The S&P was above its 200-day moving average every day last year. That's only happened a few other times. Average returns the next year were half the historical average. And then we had over 50 new highs last year, and prior years we were down the next year.
High beta momentum speculation is starting to roll over, marked by the quantum computing bubble starting to pop and the VIX pressing up against the long-term average. Now again, this could be an opportunity for a bounce. The CNN Fear and Greed Index is at the lows, correlated to the market finding a floor, while the fund manager's survey has almost de-risked to levels associated to a market bounce. But if we're going to get positive on risk, we need inflation expectations to come lower.
If you take PCE inflation, which is our 2% target, and you ask over the last 6 months, what has inflation been? The answer is 1.9%. If conditions are stable and we don't have an uptick in the inflation rate with stable and full employment, I think that the rates should go down to what I consider to be neutral 12 to 18 months from now. They would be a fair bit lower than they are today.
Now, on the more positive front, the economy is improving. Unemployment fell and jobs growth doubled the estimate.
Talk about this jobs report, which is double the estimate.
You're never going to hear me complain that we got 250,000 jobs.
It's a strong report, and that's good for earnings.
The manufacturing and service sector conditions are starting to accelerate. There's no doubt economic growth is showing a re-acceleration, even if it's at a slower pace. And with the re-acceleration of growth, the market can expect better earnings growth. As a matter of fact, the S&P is expected to report the highest fourth quarter earnings growth over the past 3 years. But it's always about guidance, and interest rates are one factor to growth, which means higher rates pretty much cancel out any expected growth. The message here is simple. Don't jump in front of a moving train. Rising interest rates, a rising dollar, and rising oil is a complete risk-off event. Until there's some evidence of inflation cooling down, the bull market's on pause.
If yields begin to fall because inflation pressures are easing, it really puts the Fed back in focus. I don't think yields are necessarily moving higher over the next few months.
Now I think what investors have to say is, oh my goodness, all right, if the 10-year goes into the fives, Earnings are going to be good, but I have to take that into account. And I said that this could be the year of a correction. I don't think it's going to be a big collapse. The VIX, I think, crossed 20 today. That's a lot of hedging in the market.